Fed is obviously eager for a downshift at some point.
The Fed, in our opinion, is nowhere near the end of raising rates. They're going to continue to go.
If the Fed were to ease up, I think it would be a relief to a huge amount of economies around the world.
There's a clear case to make that the outside of the Fed, that we're getting the sort of stage one of the pivot. I'm not sure we're quite there yet in terms of the Fed.
You pivot too soon, or if you step down too soon, and second round effects are starting to de-anchor, then you run the risk of actually losing your credibility as a central bank.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 9 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Decision day at the Fed. Policymakers are set to deliver another supersized interest rate hike. They may also open the door to slowing down the pace. The elephant in the room. Global bankers at the Hong Kong Financial Summit are avoiding one major topic, the growing risks of investing in China, and the slump on the high seas. Shipping giant Maersk cuts its forecast for the global container market. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta and Kailey Leinz in New York. Matt Miller is off today. And Kailey, as we head towards the Fed, of course, markets are going to be very focused on that. And pivot or not to pivot is going to be one of the key questions. And crucially, any timing around that will be watched really carefully.
Yeah, do we call it a pivot? Do we call it a step down now, Anna? Either way, that is really what this market is looking for. The question is, how does Jerome Powell message that without really easing financial conditions, which is something the Fed does not want to see? So we all await that come 2 p.m. Eastern, or really 2:30 p.m. Eastern, when the chairman takes the podium. Obviously, Asia had to trade in advance of that, and broadly, it was a higher day. We are still unsure how to price the speculation, the rumors about potentially the abandonment of COVID zero policy in China. We have not gotten any confirmation of that, yet you saw the rally continuing in both China and Hong Kong, where the Hang Seng Index rose about 2.4%, its best 2 days going back to March. So we'll continue to watch for updates there, even as we see lockdowns in places like Zhengzhou around the Foxconn plant because of an outbreak there. In the bond market in New Zealand, I really wanted to point to the 10-year yield up 14.5 basis points to 4.41 after we saw a big acceleration in wages, inflationary pressure within the labor market, and that is leading to a ramping up of bets that they're actually going to move 75 basis points this month after 5 50 basis point hikes in a row. And of course, it is also a 75 basis point move we expect from the Fed today. What is interesting is, even though that creates an even bigger policy divergence between the Federal Reserve and the Bank of Japan, we are seeing the Japanese yen strengthening against the U.S. dollar this morning by about 0.75%. 147.15 is where we trade on dollar yen. Traders may be potentially watching for any further intervention should we have a hawkish Fed later this afternoon, Kriti. But of course, we'll have to wait and watch and see.
Well, Kailey, what's so interesting about the fact that we have an FOMC decision today is that futures are actually higher in anticipation of that. That never happens. We tend to see a little bit of a sell-off Monday, Tuesday, even going into the Fed. This idea of essentially sell the rumor, buy the news, that's at least been the kind of the dynamic that's played in the last couple of months. Today, though, and I want to argue yesterday as well, that hasn't been the case. The future's actually up about 0.3%. And I would argue it's really all coming down to the dollar. Take a look at the Bloomberg Dollar Index, down about 0.3%. What's interesting, though, is that it's not actually following the yields picture, because the 10-year yield hovering around 404, no real change, Anna, when we're looking about actually what's happening in terms of the bond market, at least intraday at the moment. That could all change with just one word from Chairman Powell. But I want to say, once again, it comes down to the dollar, not just for the stock market, but for the commodity market as well. Take a look at the Bloomberg Commodity Index, actually up 0.5%. That dollar weakness likely boosting that just a little bit.
Yeah, Kriti, here in Europe, we see some fairly inexplicable gains across European equity markets as we wait for the Fed, as we continue to price in perhaps some of that speculation around opening in China, flying in the face of the evidence on the ground where we're seeing further lockdowns. We'll get to that theme shortly. But sentiment around Europe, not even taking too much of a hit from the manufacturing PMI data that we just got. Perhaps this already priced in. Euro area October manufacturing PMI coming in at 46.4. So that is very weak. It's below 50, of course, suggests contraction. It is just below the preliminary reading as well. So it is a worsening picture for manufacturing at the margin. Not really taking the edge off these markets, though, which are essentially waiting for the Fed. Maybe it is dollar related, as Kriti suggests, and maybe the move in Brent is partly to do with that. Let's have a look at where we are on some of these other assets. The Brent price moving a little bit higher today. Well, it was now fairly flat. In fact, it had been rising yesterday on the China story, the China narrative and speculation. Then inventories data stepped to the fore, and that was causing some moves higher in the Brent price, but just moves a little lower this morning. AP Muller Maersk, this is the Maersk shipping company, also does landside logistics increasingly, though. The company down by 5.4% because of what they've had to say about global container demand. We all know that freight rates have been dropping. That's well established. But the company came forward with a gloomier forecast for what this year will look like in terms of global container demand. And that picture seems to be worsening quite quickly. We'll bring you more of our conversation with the CEO a little bit later. Next, this is a bellwether for the UK High Street, up by 2.3% today. Their numbers actually pleased markets, and they've stuck to their guidance, which was seen at the margin as a positive, given the cost of living pressures you might expect to see exerting themselves on this type of business. And Aston Martin is down by 11.6%. On days like this, I do wish that Matt was here, because he would like this story, of course. Not the direction of travel for the stock, and not the story itself in detail, but this is another company reporting that they are still facing supply chain issues as we all face look into what's going on in inflation, and we get ready, of course, for the Fed. Important to keep in mind some of these stories that we're still seeing supply chain disruption out there, Kailey.
Yep, it's definitely a micro story telling a bit about the macro picture. And on that macro policy picture, the Fed, as Anna mentioned, is looking set to deliver a fourth straight supersized rate hike today. But economists are split on whether the tightening pace will stay steady or slow in December. White House economic advisor Jared Bernstein spoke with Bloomberg's David Weston yesterday, talking about how President Biden endorses the Fed's moves.
He has said, I am going to stay out of the Fed's knitting when it comes to this rate hiking cycle. Now, history is littered, including the previous administration, with presidents who took a different position and got in the Fed's grill anytime they were raising rates. The president has, in fact, endorsed their pivot and argued that they are the first and foremost inflation fighter, and that's where we're going to stick it.
Obviously, the pivot he's talking about is the pivot from easy policy to tighter policy, not the pivot we've all come to talk about in recent months. Bloomberg's Valerie Teitel is joining us now for more. So, Valerie, can Powell signal a slower pace of hikes while pushing back against any interpretation that it implies a lower terminal rate and, by extension, not easing financial conditions?
Yeah, Kailey, that's the big question. It's all going to be down to how he justifies the step down. Now, we know that the Fed's terminal rate, the market pricing is around 5%. It's stalled there recently, which has allowed the equity market to rebound nearly 8% from lows. Now the finesse and how he messages, hey, I want to retire 75s, but that doesn't mean that this terminal rate should come down any lower. It's going to be very, very watched. Now, we can look at some recent data, the JOLTS data yesterday, for example. That's coming in hot, right? There is not a lot out there that he can use to justify that it's time to step down. Now the job openings data yesterday, it was a game changer, I think, because we know that this data specifically tracks wage inflation. That is a core services inflation metric that is very, very important for the Fed to see some drop down in core inflation before they take their foot on the gas. Now, we know that it's not just the Fed who wants to retire 75s, but the Bank of Canada, the ECB, the RBA. But it's still unclear now that we've not seen any labor market cracks in any developed economy, no core inflation cracks in any developed economy, and no real wage inflation cracks in any developed economy. How will central banks justify this step down? Certainly something we're going to be keeping our eye on. Bloomberg's Valerie Teitel, we thank you as always. Let's get over to the Global Financial Leaders Investment Summit in Hong Kong. Wall Street's biggest bosses gathered for a panel where they discussed inflation, market volatility, and whether central banks can engineer a soft landing. One major topic was avoided, China's growing risks. Meanwhile, HSBC CEO Noel Quinn struck an optimistic tone on the topic. He spoke to Bloomberg's Yvonne Mann and David Ingles at the event.
It's a huge consumption market. It's a consumption market that no one in the world can afford to just walk away from, in my view, in that it's got a huge opportunity. It's still a very significant supplier to the world as an export market. So I believe in the economic prospects of China going forward.
John Liu, Bloomberg's executive editor for Greater China, joins us now from Beijing for more. John, thank you as always for joining. We're kind of feeling a little bit of a tug of war when it comes to these Chinese risks. On the one hand, well, they're actually perhaps maybe considering this kind of release on COVID policies. At least those rumors were enough to boost the market yesterday in the pre-market. But then at the same time, you also have this massive shutdown around some of this iPhone manufacturing. At least that's how it impacts the United States. Square the two for us.
Well, we've seen the market react to speculation that China may open up in terms of its borders, open up in terms of regulations on companies and its lockdowns. We have not seen any actual action to suggest that. We have not seen any official announcements to suggest that. Indeed, we've seen the opposite, just as you mentioned with the plant in Zhengzhou, where 4 out of every 5 new iPhones is made. We are seeing more lockdowns. We've seen that in the city of Wuhan. We've seen it in the city of Shanghai as well. And so the authorities sure do not act like they are planning to loosen up. Markets, of course, are acting differently. I think, if anything, the most definitive thing we can say is markets are eager for any news about a potential opening up of this economy.
Yeah, John, I like the comment from our colleague John Authers, who said markets like COVID zero so little that they will literally believe anything, which seems to be a fair way to describe what we saw from markets in the past 48 hours or so. Back to where Kriti was starting this conversation around this gathering in Hong Kong of Wall Street executives, all talking very animatedly about the global economy, the challenges it faces, but not talking really about risks, geopolitical risks attached to investing in China.
Well, this event, it was put together as a way to show that Hong Kong was back open for business. And these CEOs were invited to try and headline that event to show that, again, Hong Kong has become a financial center. And so I think what you see is these CEOs obviously coming, trying to do that, trying to show that they are bullish about not only Hong Kong, but China. And we've seen at the end of the third quarter, the world's leading arranger of share sales was CITIC Securities from China. It's the first time since 2009 that it was not an American firm leading that league table. And so you see where business is at. And obviously, those CEOs have a mind for business.
All right, Bloomberg's John Liu reporting from Beijing. Thank you so much. Let's turn now to corporate news. Amazon is taking more drastic measures to align expenses with the slowdown in sales. Bloomberg has learned that the world's largest e-commerce company is freezing staffing levels in its profitable ad business. The decision to keep the ad unit's workforce at its current level shows Amazon is looking to squeeze more profit out of it. Amazon shares right now up about 0.5% in pre-market trading. As for some other movers to keep an eye on in pre-market trading, one of them is AMD. It gave results after the bell yesterday, and in contrast to other chip makers, they were pretty solid. Its revenue forecast for the fourth quarter, topping expectations. They're really benefiting from their pivot to server processors, so that's helping offset the slowdown in the PC market. And they think revenue could be up 14% in the current period. Compare that with double-digit declines for rivals like Intel and NVIDIA. So they're faring fairly better here. As a result, they're up about 4.5% in early hours. But it is a downside move for Airbnb, which also reported after the bell yesterday. Soft bookings forecast for the fourth quarter. It shows kind of a pivot in consumer traveler behavior as we emerge from the pandemic. They want to go back to urban areas, cross-border, rather than getting Airbnbs in the countryside, for example. So as a result, Airbnb down about 6.25% before the bell, Anna.
Okay, some interesting pre-market movers. Coming up on this program, Steve Blitz joins us, TS Lombard Chief US Economist, the perfect voice to chime in ahead of the Fed today. And more on that gloomy view from the shipping giant Maersk. We'll hear from the CEO later this hour.
Our own volumes are down 7% for the first 9 months of the year compared to last year. We see the effect of the slowing economy, the war in Europe, and what that has done to consumer confidence. So all in all, global trade is moving backwards this year.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta with Kailey Leinz in New York and Anna Edwards in London. Matt Miller is off today. Do you remember when we were talking about transitory inflation? It kind of feels like ages ago before we kind of accepted that inflation may be here for the long haul. Well, I have a chart here, and for our radio audience, stick with me, that shows container shipping rates. Now, it goes all the way back to 2011. You kind of have a little bit of a boring chart, nothing too exciting, until, of course, in 2020, these rates really skyrocket to a peak in about the middle of 2021. That peak has been completely retraced, though, kind of making a full U-turn. And it's interesting when you think about that in the context of supply chain issues, because we were talking about that a lot in 2021. 2022 became more of a commodity inflation kind of story. But when you start to see those original issues dissipate or fade, perhaps. I wonder how the Federal Reserve really views that. And to give us a little bit more context, I want to bring in Ben Rahm, the Bloomberg cross-asset strategist on the Markets Live team. Of course, Ben, let me put that question to you. Should we not worry about the supply chain issues that are obviously still there, but perhaps don't show up in metrics like freight rates, for example?
Morning, Kriti. Absolutely. I think that, we started the year with 7% headline inflation in the US, and now we are at 8.2%. So those supply chain pressures don't seem to be dissipating anytime soon. And that is going to be a key concern for the Fed. Everyone knows that this is likely to be the fourth big jumbo hike that we are going to get from the Fed today, 75 basis points. But beyond that, what is the signaling going to be? And that's going to be the key. And if there is a change in language that says that the Fed is anticipating that any change in the language where they say that the Fed committee anticipates the ongoing increases in the target range will be appropriate, that will be the key to watch today. And also, I'm expecting some kind of a dissent from Esther George. So those are going to kind of set the framework for the market's reaction going forward.
Okay, so that's what we're watching out for in terms of any dissent and the overall messaging then from the Fed. Help us understand some of the terms that get thrown around here, Ben. I mean, a step down, not necessarily a pivot then, you've explained in some of your writing this morning. If we did see explicit guidance around some kind of upcoming step down, that would be something new though, would it?
That would be new in terms of only so far as they acknowledge what the dot plot has said already in September, that smaller increases. If you look at the median rate for year-end rate for the Fed funds rate, it's 3.4%, and so we are already getting there, and therefore the Fed will signal a smaller pace of increases, but that doesn't mean a lower terminal rate. The markets are right to price in a terminal rate of 5% at the very least at the moment. And the Fed and Powell will particularly be careful in nuancing that message that a slower pace of rate increases doesn't mean a lower terminal rate, because as I just mentioned, we have gone from 7% inflation to 8+% inflation. And therefore, the Fed has no room to be complacent about inflation, and they definitely do not want to be going down in history books as another Arthur Burns who kind of prematurely stopped easing when there was a case not to ease.
So, Ben, maybe the Fed doesn't have room to become more dovish. I guess the question is, do they have room to be even more hawkish? And if we've seen peak hawkishness, ultimately, does that mean we have also seen peak dollar strength, peak rates?
That's a great question, Kailey. I think, yes, we will see peak. We have probably seen peak hawkishness from the Fed, but we haven't necessarily seen the peak of the dollar because I do think that, if the Fed funds rate go to 5%, as the markets are expecting them to, I think there's a lot more to be priced in for the dollar index, and for U.S. front-end rates, specifically the 2-year yield, I think has room to climb higher. And I think that in that kind of environment, you want to be invested in assets like gold, which this morning we did a study that shows that its convexity has come to the fore, and its duration is the lowest of all the assets that we have analyzed.
Ben, thanks so much. Bloomberg's Ben Rahm with his analysis of the markets, how to cope with the Federal Reserve and what are the likely messages to result from the FOMC meeting. Of course, we'll bring you full coverage of that. We'll return to that conversation shortly this hour as well. For more market analysis, check out MLIV Go. That's the function to use on your Bloomberg terminal. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Kriti Gupta in New York and Anna Edwards in London. Matt Miller is off today. Now, keeping you up to date with news from around the world, here's the first word. Hong Kong is fighting to prove it's still a dominant financial center. That's despite 3 years of tough COVID restrictions and political upheaval. Officials say the city's advantage is its super connector role to mainland China. To show off its comeback, Hong Kong is holding a summit this week that includes top bosses from all of the biggest global banks. CVS, Walgreens Boots Alliance, and Walmart have tentatively agreed to pay more than $12 billion to resolve thousands of state and local government cases involving opioids. The suits accuse the chains of mishandling the painkillers, which are blamed for 500,000 deaths in the U.S. over 2 decades. States, counties, and cities still have to sign off on the agreement. In Israel, the 5th election in 4 years looks set to return Benjamin Netanyahu to power. Exit polls show that his strategy of forming an alliance with the nation's far right has succeeded. The pro-Netanyahu bloc appears to have just enough seats to form a slim majority in parliament. And in Brazil, President Jair Bolsonaro has promised to follow the constitution and ordered the government to start the transition to incoming leader Luiz Inácio Lula da Silva. Bolsonaro stopped short of conceding defeat 48 hours after the election, but the remarks are seen as a gesture he'll honor the results of the voting. And of course, it raises a question of whether we will see similar behavior after the midterm elections here in the U.S. next Tuesday. But before we can get there, we have a number of events to get to, including today's Federal Reserve decision, Anna, and we're going to talk about that next.
Yeah, absolutely. We'll talk to Steve Blitz, TS Lombard's Chief US Economist. We'll get his perspective on, of course, 75 basis points seems to be what the market expects. But what is the language that goes around that? We'll get Steve's view next. This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. Decision day at the Fed. Policymakers are set to deliver another supersized interest rate hike. They may also open the door to slowing down the pace of those hikes. The elephant in the room. Global bankers at the Hong Kong Financial Summit are avoiding one major topic, the growing risks of investing in China. And the slump on the high seas. Shipping giant Maersk cuts its forecast for the global container market. I'm Anna Edwards in London with Kailey Leinz and Chrissy Gupta in New York. Matt Miller is off today. And in terms of the European equity markets, Chrissy, and US futures, last half hour we checked, things were looking sort of range bound, but slightly positive, perhaps more so than you might expect on the cusp of yet another jumbo hike from the Fed.
It almost makes us wonder if some of these equity investors know something that perhaps the rest of us don't. You are seeing a little bit of green on the screen, Anna. To your point, when you look at the S&P 500 futures to the tune, well, it was up about 0.3%, now pairing some of those gains, but still kind of a positive inclination. I would argue not really happening much in the bond market, though. Still hovering around 403, 404 on the 10-year yield. But the Bloomberg Dollar Index is what's interesting to me because you're seeing a little bit of variation in the futures, but not really in the dollar, which, by the way, in the last couple of days has been taking its cue from what's been going on in the bond market. Interest rate differentials, or the potential of them, I should say, actually driving the dollar today only weaker by about 0.2%, but I think enough to perhaps give the entire commodity complex a little bit of a boost. Remember those China risks, the idea of the Ukrainian grain issues that you're still seeing, all of that is going to create a little bit of a floor under commodity prices right now. And I think that's what you're seeing this morning, up about 0.7% on the Bloomberg Commodity Index, Kailey.
All right, Creedy, well, let's also take a look at some movers because, yes, we are focused on the Fed and macro policy, but it's still earnings season, so there's still some micro stories out there. One of them being Advanced Micro Devices, AMD, the chip maker. It reported results after the bell yesterday, actually gave a really strong forecast compared to some of its competitors. It's benefiting from its shift towards server processors, helping offset some of the weakness in the PC market. So it is up about 4%. And Yum China also topped expectations on profit. Comp sales better than expected as well. So it's up about 12%. But part of that story is just the broader rally we continue to see in U.S. listed Chinese companies as we contend with the potential, maybe rumored opening of the economy, reopening of the economy, abandonment of COVID-0. We've gotten no confirmation of that, and yet it is still leading to a boost for some of these names, including Alibaba, which was up more than 3% yesterday and is up another 3.5% this morning. To the downside, though, Airbnb, weak forecast when it comes to bookings, shift in consumer behavior weighing on the company, so it is down more than 6% before the bell, Anna.
Yeah, not only have we got no confirmation of a pivot away from COVID-0 policy, Kailey, but we've had evidence to the contrary with lockdowns around that Foxconn factory in one part of China at least. So, Kailey, let's have a look at where we are on European equity markets because we still feel the lingering of that Chinese story, as you rightly mentioned, from yesterday. But giving up on earlier gains, and the Stock 600 is now pretty flat, heading towards the Federal Reserve meeting. A lot of interesting components, though, going into the markets today. One of them coming through from A.P. Møller-Mærsk, the shipping business based in Denmark, a big global player, down by 5.5%. They have a lot of insight into what's going on in the global shipping business, and they've brought down their estimates for global container demand this year. That's been taken negatively by the markets, despite the fact that they've been doing a lot of landside logistics investment and trying to pivot the business in that direction recently. We'll play you some more of our CEO conversation around that shortly. The next share price is up by 1.8%. This is a UK clothing retailer, a bellwether of the UK high street, it's often described as. And they actually managed to meet estimates, and the numbers being well received by the markets. The fact they didn't cut their guidance was something that some analysts pointed to as a positive. And down by 14% on the Aston Martin share price. The luxury car manufacturer then, Kailey, still dealing with some of those supply chain issues that we've talked about for so many months now.
Yep, supply side issues that continue to plague policymakers around the world because it continues to fuel inflation. That is, of course, something the Federal Reserve is going to try to fight today as it looks set to hike 75 basis points for the fourth consecutive meeting. The question is, what comes after that? Joining us now is Steve Blitz, TS Lombard Chief US Economist. So, Steve, coming into this meeting, we all pretty much expect 75 basis points. The question is, do we get confirmation of a step down in the meetings to come? How can Jerome Powell thread that needle, potentially signal that, but not lead to a huge rally in risk assets that eases financial conditions and works against what he's trying to achieve?
I don't know. I think that's a very hard thing for him to do, to be honest. So he's going to, at the meeting, he's going to give a simple explanation for what it takes to slow down, and he'll say the same thing, that it's data dependent. You know, the biggest risk that they have of going from 75 to 50 is it precludes them from going from 50 back to 75, say in February. And so that's one of the reasons why the Fed is always reluctant to make that first hike, to make that first, will you say, pivot, that first cut, because they never want to reverse themselves right afterwards.
Well, to that point, Steve, we heard Larry Summers, the former U.S. Treasury Secretary, talking about that yesterday, basically saying the bigger risk is that the Fed ultimately turns too soon, they pause too soon. He tweeted that there's a growing chorus that the Fed should pause very soon for fear they will throw the economy into recession, given the lagged response of monetary policy. I believe this advice is badly misguided. How misguided do you believe that is, Steve?
I don't often agree with Larry Summers, but in this particular case, I do. I mean, if you look at, see, part of the problem is people are looking at things like the drop in container prices. And yeah, you're going back to 2018, 2019 levels. So that's not a recession in terms or a collapse of demand. It's just an end of a surge. But what you're left with today versus 2018-19 is a fundamental imbalance between the supply and demand of labor for a lot of reasons, which I've discussed here before, and that's not going to abate itself. And that's the underlying inflation that the Fed's really trying to attack. And is that wage inflation. The only way you get around that, unfortunately, from the Fed's perspective, I mean, there are policy answers longer term, but from the Fed's perspective here and now, is to create a higher unemployment rate. And and even in their SEPs, they had 4.5%. So you don't get from 3.5 to 4.5 without a slowdown in the economy.
Right, Steve, good to see you here in London.
Yes.
What do you expect to see in the data then as we go through the months ahead? Because if the Fed wants to step down, if the Fed wants to pivot in some way and stop these jumbo hikes, they'll need some data to sort of pin that on, one assumes.
Right.
Is that most likely to be a drop in core inflation, some quote-unquote success in increasing the unemployment rate? I mean, what are they going to be able to point to as having changed?
Well, I think the main thing they're going to focus on is less the inflation numbers. And they always look at everything through a 3-month moving average, right? But they want to see at least the employment numbers dropping into the 100s as opposed to being over 200. 100,000 is considered neutral. So if they start seeing a 125, 150 kind of number, and they see inflation starting to ebb off, then I think they'll feel a little bit better about where they are. But as much as they've tightened, remember, money is still cheap. Right? And people claim about problems about liquidity in the marketplace. What's your benchmark? Is your benchmark for liquidity a zero funds rate and the Fed buying $80 billion a month? That's not really liquidity. I mean, that's not really a normal sense of liquidity. So yeah, so I think the employment number on Friday is probably much more important than the CPI number next week.
Okay, so we're focused on the job story and whether there's a change in the data there. But we are going to see more tightening this year from the Fed in any calendar year, breaking the records from 1979 and 1980. And I take your point that maybe rates are still historically low.
Right.
But are you at all concerned that perhaps this is just loading a whole lot of slowdown into the US economy that we just haven't seen yet?
I think they're just in catch-up mode. I think that, you know, if you look at where the economy was in March, I mean, they were starting to signal that they needed to tighten the fall of last year. They waited till March, and they only did 25 basis points, right? They were ready to do 50, but the war pulled them back. There was no way, given the growth and inflation we saw in March, that the funds rate should still be at zero, right? And so they are still far behind nominal. You know, you talk about earnings. Think about what nominal revenue growth is for companies and their cost of borrowing at the short end, commercial paper. It's still a tremendous positive carry on inventory. You never get a slowdown in the economy until that carry cost goes negative. And we're far from being there. So yes, they've done a lot because they've waited so long and everything got away from them. Right, and you know, and equally, you know, the market. I find it hysterical how people have these terminal rate points, right? And it's like, what gives anybody confidence that the Fed suddenly knows the exact optimal rate to stop at to achieve the result that they're looking for? Then. No, I mean, I believe that they believe it, but, you know, what gives anybody a sense of that they have this credibility of foresight based on what they've done the last few years?
Kriti, jump in.
Well, Steve, I want to ask you about the fiscal response, actually. I mean, it's quite clear that there is this debate on the monetary front. Are you worried at all about what the Biden administration might do to kind of influence perhaps the reception of these massive rate hikes? I'm talking about not just the windfall tax, but the idea that as we get closer and closer to a recession and the midterm elections and the presidential election, what about the fiscal response?
Well, I think the fiscal response, I think we can assume here that the House is going to go Republican. And I think the Senate is probably still up in the air. And once you get a Republican Congress, you're not going to get any fiscal response out of the government unless you get a recession that shoots up the unemployment rate to 8%, whatever, something like that. And that always gets you a bipartisan fiscal response of some sort or another, and usually gets something passed. But barring that, you're not going to get any fiscal response. The fiscal side is basically locked in from now for the next 2 years. Obviously, the Democrats want to, I'm sure they like the equity market doing better right now. And I think they also, you know, they don't want a recession and high unemployment heading into 2024. And my advice to them is that, therefore, they should let the Fed get really tight and have the recession now. And therefore, in 2024, you're in recovery and people are feeling better about things. But, you know, but in terms of what you're asking, actual spending plans, the one thing I would say is that, you know, that infrastructure plan that was passed, we should start seeing a lot of the spending from that in 23 and 24. So there is sort of talking about leads and lags, you know, there's about a 12 to 18 month lag between when you sign a bill for something like that and when the money actually begins to be spent.
That's a really interesting point, Steve. Thanks for joining us. The lags on fiscal and then on monetary policy. Thanks very much for joining us today. Steve Blitz of TS Lombard. A pleasure to have him here in London with us. Coming up on the programme, Maersk cuts its forecast for the global container market. More of our interview with the company's CEO, Soren Skou. That's still ahead. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kailey Leinz and Kriti Gupta in New York. Matt Miller is off today. Now, the shipping giant Maersk reported third quarter earnings that beat estimates. However, the company is cutting its forecast for the global container market, seeing demand shrinking as much as 4% this year and another possible contraction next year. The company's CEO, Soren Skou, spoke to Mark Cudmore and me a little bit earlier.
Volumes are down, global trade volumes are down, our own volumes are down 7% for the first 9 months of the year compared to last year. We see that as being driven by a number of factors. Certainly, durable goods are down. Probably a lot of people over-invested in durable goods in the early part of the pandemic. And then, of course, we see the effect of the slowing economy, the war in Europe, and what that has done to consumer confidence. So all in all, global trade is moving backwards this year.
Soren, as you say, it's going backwards. This is a very, very bleak outlook. I'm trying to understand how dramatic this is to the global economy. You know, you've had an awesome third quarter, but now you're rapidly downgrading forecasts. That's the same story we've seen in GDP prints. We've seen great GDP prints for third quarter around the world, but we've suddenly seen PMIs for October be super negative. Does this mean that we're like going to recession much quicker than we were thinking only a month ago?
I think part of it is pandemic effects. Many of us bought a new TV and a new couch and a new barbecue during the pandemic because we didn't have anything else to spend our money on, and obviously that will be a few years before we have to do that again. So part of this is front loading, if you will, on goods spending that happened early in the pandemic, and that's impacting negatively now. But the other part is that the economy has slowed down. Certainly, if you, like I do, live in Europe, it's really hard to be very optimistic with a war on our doorstep and a big energy crisis in this winter. So that is impacting consumer demand, consumer confidence, and therefore also demand. I think it's quite likely that we either are or will soon be in a recession, certainly in Europe, but potentially also in the US.
So we're seeing declining freight rates, which suggest declining demand, and yet we're about to see an explosion of supply side of capacity. How dramatic is this going to be, this prolonged kind of overcapacity episode?
Well, I think it's natural and also good that the freight rates come down from these super elevated levels to something that is more normal. That's clearly better for the economy and for our customers. What matters in container shipping is not really how many ships exist. What matters is how much capacity is being deployed towards the demand that is actually out there. So I usually don't try to predict freight rates, but it's very clear that they are on a downwards trajectory, and we will see where this lands or normalizes.
That's the Maersk CEO, Soren Skou, speaking to Mark Cudmore and to me a little bit earlier on. And Chrissy, it's interesting when you try and take macro signals from what we're hearing here at the micro level. Freight rates coming down might sound like a good thing for the global economy, but as he was also pointed out to us many times, operators in this space have spent the last couple of years trying to lock in their deals with the customers that they serve on long-term contracts. So some of those elevated levels of freight rates that you showed earlier on in that chart, they might just linger and therefore apply upward pressure to inflation for a little bit longer.
Well, then you have to also ask yourself how much of that is really this kind of macro signal, for lack of a better term. At the same time, remember, some of these freight rates have diverged from commodity rates or commodity prices. These are two charts that tend to mirror themselves quite closely, and yet you are still seeing freight rates come down, whereas commodity prices continue to stay up at a time when the global environment is also talking about deglobalization. So do freight rates still hold that macro signal, Kailey?
Well, and on the subject of macro signals, the Fed has to look at all of them. It is Fed Day, so coming up, we're going to talk more about that and the broad consensus of a 75 basis point hike and question mark of what comes after that. We'll be live in Washington next. This is Bloomberg.
Generally speaking, when we've had these periods in the past, it takes somewhere between 2 and 4 quarters, sometimes maybe 6 quarters, to rebalance. I think we're going through that rebalancing period. I think there's still a significant amount of uncertainty, but as we get into 2023 and we start to have a clear understanding of the trajectory of capital markets.
The world, however, is 3 parts. Whilst I think we agree the US is relatively attractive on a comparative basis, I think Europe has very big issues. China is, whilst we're all very pro-China, and like Vice Chairman Fang said, we're not reading the American press, we actually buy the story, but it is a bit waiting for zero COVID to open up in China and to see what will happen.
That was the chairman of UBS and the CEO of Goldman Sachs speaking at the Global Financial Leaders Investment Summit in Hong Kong. All right, now let's take a quick look at what is coming up for the rest of the day. Qualcomm is due to report its earnings results at 4 p.m. Eastern. We'll get some U.S. economic data, including MBA mortgage applications and ADP employment change ahead of Friday's jobs report. But the big event of the day, it is the Fed rate decision at 2 p.m. New York time and the chairman's press conference 30 minutes later. Creedy, that really is all we are waiting for.
75 basis points priced into the market. But there's a lot to parse through. We're talking about housing, inflation, jobs numbers. I mean, you name it. There's a lot to digest. Mike McKee, our international economics and policy correspondent, has a busy day. Today's his Super Bowl. He joins us now for more on the Fed decision. Mike, what will you be parsing through? What's on your radar?
Well, Creedy, the November meeting today is basically about the December meeting. What are they going to say they're going to do next? We've already locked in a 75 basis point move for today. The markets have priced that in, as you've been talking about. And there are no new dots or forecasts at this meeting. That comes in December. So what is it they're going to do in December? Are they going to step down to maybe a 50 basis point move? Remember, 50 basis points is a lot. 75 is very, very large. They've done 3 in a row. This will be the 4th in a row. So they could easily step down and not have too much of an effect on the economy. The question is, what do the markets think about that? And what the markets want to know is how high will rates go and how fast are they going to go? The statement is probably not going to say anything other than we will continue raising rates. But Jay Powell has a news conference, and you can see here kind of what the important question is. If he sounds too dovish, then we see financial conditions start to get looser because markets are going to rally. The Fed doesn't want that to happen.
Yeah, absolutely. So he'll certainly be mindful of the impact of his words on financial conditions, Mike. I mean, how are you looking at the question of whether we are going to see signals around a step down or a pivot? Because I thought a lot of the conversation over the summer was all about how forward guidance for central banks globally was sort of a thing of the past and they wanted to be data driven. How do we deal with that? But then the market's expectations, the market's desire for some kind of commitment.
The Fed is going to just have to ignore that market desire, and I think Jay Powell is going to come out today and say we're going to continue raising interest rates, and the rate at which we do so and how high we go is going to depend on the performance of the economy. Then we'll have a number of economic indicators, 2 CPI reports before the next Fed meeting, 2 jobs reports before the next Fed meeting, and the markets will then find a new price based on what they think the economy is doing at the time, as will the Fed.
Mike, thanks very much. Bloomberg's Michael McKee joining us there live from Washington. He'll, of course, help lead our Fed coverage from there. We'll have plenty more on the Fed decision later on today. And, Chrissy, interesting to see what happens in FX markets. Of course, strong dollar has been something of a feature of 2022, much to the desperation of many emerging markets and other developed markets, actually.
Well, what's interesting is that we've been talking about a kind of 5% peak terminal rate kind of stalling out, and that perhaps giving a bull case to the equity market also creates a bear case for the dollar, Kailey. And I think this is such a crucial point about what the ripple effects are. We might actually just see that today upon the decision.
Yeah, it's a question of if we have seen peak dollar strength, if we have seen peak hawkishness. I guess we will find out an answer to that later today, Anna. It's not so much about the actual decision itself. It's about the language and the tone coming from Chairman Powell.
Yeah, and how much of the market response lasts through the jobs report. That comes thick and fast, of course, just 2 days later. We'll have that for you on Friday. That is it for Early Edition. Surveillance is up next. Tom, John and Lisa are making their way to their chairs for that programme. They'll have plenty more in the build-up to the Fed and analysis of the Fed later. This is Bloomberg.